Welcome back guys, my name is Angelo. It's important that you find an investment strategy that you find motivating and easy to stick to long term. While I'm happy with accumulating ETFs which automatically reinvest dividends into more shares of the stocks within the index, other people prefer to see the cash flow their investments generate paid out to their account on a regular basis. For some, it could even be the difference between selling an investment at the worst possible time, for example during a market downturn, or holding on to it long term. That's why today I want to show you a few different ways you can create a steady stream of dividends using low-cost broad-based ETFs. Not only that, I'll show you some combinations you can use to receive dividends, not only once a quarter as is often the case with many distributing ETFs, but every single month of the year. We'll also take a look at how much capital you would need to have invested into each strategy in order to receive 1,000 euros in dividends each month based on current yields. Alright, let's not waste any more time and get to our portfolios, each of which is made up of only 3 ETFs to keep things simple. Starting with portfolio number 1, where the first ETF is one you probably know by now if you've been following the channel for a while, the Vanguard FTSE World, but in this case in a distributing version. It invests into over 3,600 stocks of publicly listed companies from all across the world according to their market cap, and the index returned 8.38% per year on average over the past 20 years according to a backtest. It currently has a dividend yield of 1.9% per year, with dividends being paid out every quarter in March, June, September and December. And yes, a dividend yield of close to 2% is nothing to write home about, but that's because it doesn't exclusively invest into companies that pay out dividends and thus provides you with more diversification. This means you also hold stocks like Amazon, Google, Netflix and Tesla in your portfolio, which you would otherwise miss out on. Now let's take a look at the second ETF, the Fidelity Global Quality Income, which tracks high quality companies from developed markets which offer high dividend yields. This one exclusively invests into dividend paying stocks. According to S&P Global, the index returned an impressive 9.29% per year on average since 1997. The ETF currently contains 253 stocks according to Just ETF, has a dividend yield of 3.05% right now, and distributes those dividends in February, May, August and November. This means that by combining the two, we already have 8 out of 12 months covered with dividend payments. But I think we can do even better, so let's add a third ETF to the mix. The HSBC FTSE EPRA NAREIT Developed ETF, which tracks the largest publicly listed real estate companies in the world. This ETF provides you with more exposure to the real estate sector. With the other 2 ETFs I mentioned, they're only at 2 to 3%, while enabling you to avoid all the work and significant capital that's usually required with investments into rental properties. As for its performance, the index actually outperformed the FTSE World from 2003 to the start of 2020. Sadly, real estate companies crashed hard during the COVID period, and while they recovered nicely by the end of 2021, the high interest rate environment we're currently in pushed prices back down. But this also means this could be a good buying opportunity, especially if you believe that central banks are going to lower interest rates again over the coming months and years, which I personally find quite likely. The ETF currently contains 376 real estate stocks from across the world, has a dividend yield of 4.1% right now, and pays out dividends in the 4 months we were missing. Now, based on the current yields, here's the percentage of our ETF portfolio we would need to allocate to each of the 3 ETFs in order to receive the same amount of dividends from each on average. 48% would go into the FTSE World, which is certainly not bad since it's the most diversified of our 3 ETFs. 30% would go into the Fidelity Global Quality Income, and the remaining 22% would go into real estate stocks via the HSBC ETF. But to keep things simple, let's just do a 50-30-20 split instead. This allocation would give our ETF portfolio an average yield of 2.69% per year. So if we want 12,000 euros in dividend each year, or approximately 1,000 euros each month, we would need to have a total of 446,000 euros invested based on current yields, which translates to a much more approachable 44,600 euros if we're just looking to make an extra 100 euro from dividends every month. By the way, if you're enjoying the video so far, don't forget to hit the subscribe button if you haven't yet. Also, you can find each ETF's ticker symbol in the description below, where you can also find links to the best low-cost brokers in Europe. Now, in case you're not interested in holding an ETF that's focused on REITs and real estate stocks, but you still want to see cash flow every single month from your ETFs, then you should have a look at portfolio number 2. Here we're keeping position 1 and 2 unchanged, with the Vanguard and Fidelity ETFs covering 8 out of 12 months of the year. And now we're replacing the third ETF with the best performing MSCI World ETF out there, the HSBC MSCI World, which covers over 1,300 publicly listed stocks from developed markets across the world. With a compound annual growth rate of 9.8% per year since 1979, I don't think the MSCI World Index itself needs a long introduction. The one downside is that since we're not exclusively investing into dividend-paying companies, the ETF comes with a lower yield of only 1.74% per year. But it distributes those dividends in January, April, July and October, which are the 4 months we were looking for. Now, due to its lower yield, here's the percentage of our ETF portfolio we would need to allocate to the 3 ETFs in order to approximately receive the same amount of dividends from each on average. 37% would go to the FTSE All-World, 23% would go to the Global Quality Income, and 40% to the HSBC MSCI World ETF. With this combination of ETFs, we now have a lower average yield of 2.1% per year, which means we would need a total of 571,000 euro invested in order to receive a monthly 1,000 euro dividend payment. One easy alternative could of course be to skip the third ETF entirely, as long as you're okay with not receiving dividends 4 out of 12 months of the year. In that scenario, in order to receive the same amount of dividends from each approximately, we would put 60% into the FTSE All-World and 40% into the Global Quality Income ETF. By doing this, we would end up with an average yield of 2.36% per year, which would require an investment of 508,000 euros in order to receive the same 12,000 euros in dividends per year, in this case distributed in payments averaging 1,500 euros each, 8 months of the year. Alright, I've now shown you 2 portfolios and a simplified alternative I would personally feel very comfortable holding long term. Just so you understand my point of view as an investor and how I think, I don't like to exclude companies from my portfolio simply because they don't pay out dividends. After all, dividends are only part of the total investment return stocks generate over the long run. That's why I included broad-based ETFs like the Vanguard FTSE All-World or MSCI World in my example so far, but you're of course free to do things differently. If that's the case and you value stocks that pay dividends above all else, then take a look at portfolio number 3. ETF number 1 is going to be the Vanguard FTSE All-World High Dividend Yield, not to be confused with the normal version. It invests into over 1,800 stocks that pay higher dividend yields across the world, not only from developed but also emerging markets. With a compound annual growth rate of 6.6% over the past 15 years, its returns haven't been bad by any means. But the standard FTSE All-World index still performed significantly better, averaging 8.51% per year. That being said, it's the largest high dividend yield ETF in Europe with over 3.4 billion euros in assets under management and has a dividend yield of 3.73% per year, with distributions taking place 4 times per year. I would then keep the Fidelity Global Quality Income as a second ETF in order to cover February, May, August and November, and for some extra diversification away from financials. Most high dividend yield ETFs tend to contain a lot of bank stocks, as these tend to pay the highest yields on average, and the Vanguard FTSE All-World High Dividend Yield is no exception. And regarding the third ETF, I would go back to the real estate ETF I already mentioned, the HSBC FTSE EPRA NAREIT ETF. Since all 3 have attractive yields and pay out dividends in different months, I think this could be a good mix for income investors. In order to receive the same amount of payments from each ETF based on current yields, we would allocate 32% to the All-World High Dividend Yield, 39% to the Global Quality Income, and 29% to the REIT ETF. To keep things simple, you could just do a 30-40-30 split though. With this combination, our ETF portfolio now has a significantly higher yield of 3.57% per year, which means that we would only need to invest a total of 336,000 euros to receive an average of 1,000 euros in dividend payments every single month of the year, or just 33,600 euros for an extra 100 euros per month in dividends. Alright, those were the 3 portfolios I wanted to show you today. Keep in mind that I obviously simplified the calculations since I didn't include taxes, which are different in each European country, and dividend yields can go up or down. Now you might be wondering, Angelo, which combination of ETFs would you pick if you wanted to see monthly cash flow from your investments into ETFs? Well, I might not be the right person to ask. While I cared about dividends in the beginning of my investment journey, my wife and I switched to only buying accumulating ETFs, actually just one, the accumulating Vanguard FTSE All-World, a few years ago. We did this in part because it makes our life easier not to have to manually reinvest dividends, and because accumulating ETFs are a bit more tax efficient in most countries in Europe. Also, we don't need the extra cash flow right now since both of us are still working. Still, if I had to pick one strategy for monthly distributions, I would pick portfolio number 2. I know the 3 ETFs have a lot of overlap, but each ETF is diversified globally across all sectors, and it would still be an easy way to receive monthly cash flow from investments I'd be happy to hold long term. And yes, I'm aware that by choosing this route, my overall dividend yield will be a bit lower at 2.1%, but then again, I personally don't prioritize investments based on how much they pay in dividends. The only thing that matters to me is their total performance, so dividends and capital gains combined long term, to give me the best shot at retiring early in a few years. More on that in this video. I totally understand the psychological impact of actually seeing your investments generate cash flow on a regular basis, which is then paid out to your accounts with distributing ETFs. Chances are that might indeed be the motivation you need to stick to your investment strategy over the long run, through boom and bust cycles, as you see the amount of dividends you receive grow over time, or because it just makes you more aware of the fact that you're actually holding productive assets. So hopefully I was able to give you some ideas on how to get started and what you could use to build a portfolio of low-cost broad-based ETFs that pays you every single month. You can find all the ETF ticker symbols and the best low-cost brokers in Europe to buy them linked down below in the description, which is a great great way to support me if you would like to, apart from tapping the like button and subscribing to the channel if you haven't already. But now I want to hear from you guys. Are you more of an income investor that gets motivated when seeing dividends paid out to their account? Or do you not care and prefer the simplicity of accumulating ETFs instead? Let me know in the comments below. Thank you so much for watching, have a wonderful rest of the week, and until next time.